I'll start with mine. So, I feel um anxious. I traded a green week. I had one red day on Friday. I had a green week though because my Monday through Thursdays were amazing. And on my Friday, I didn't even try to fight back after like my first red. I just got this really defeated attitude in regards to the trades. And so, yeah, I was like, yeah. And then I just left it alone. So that's exactly why. Trading wasn't good this week, but I understand. Okay. I didn't follow my rules closely enough. My week was green, but I gave a lot back at the end. Yeah, yeah. Oh, I understand, sweetie. When I tell you I understand, my God. Ugh. Oh, we're gonna come back. It's funny, a lot of people did not have a good day on Friday. The funny thing about Friday is I was looking at Friday, and Friday was easy in hindsight if we would have been trading liquidity. So that's why I was like, yo, yeah, we finna do this liquidity. We finna do this class again. I'm finna refresh my memory, and then we're gonna talk a little bit, and then yeah, cause that a consolidated day literally gives you scalping opportunities, especially when it keeps going to the same spot. And now after they pumped at the I think it was like 2 o'clock, and they start pumping us up, that might have been a little whoa. But before that, where we were just kind of stuck and we hadn't broken out yet, in that non-breaking out zone, you could have scalped futures. And then in the breakout and the pump up, then options we should have got in. But by that time, man, we were probably ready to throw our computers, honestly. SPX played me with the inside candle on fire. I'm telling you, played us like fiddles, fiddles. I get it, I get it. Oh, and not letting my green trade. Okay, we'll talk about these things too over time. Like, my goal is to have a class every week, one day Saturday, one day Friday. So since we're having a Saturday afternoon, next time we're gonna have a Friday evening, if that's okay with y'all. You don't have to be able to attend all of them. As you can see, I'm gonna record them, so we're gonna be good. We're gonna talk about all those topics. So I'm glad you guys said that because that gives me more for us to learn about and do. So you guys are amazing for that. Thank you, thank you. Let me see. All right, so I'm gonna minimize this real quick. There we go. All right, I'm gonna minimize the chat or just bring her down just a little bit. So what is liquidity? Liquidity simply means how easy orders can be executed. In other words, how much buying and selling activity is happening at a certain price level. The market moves to where the liquidity is, and that's where big players can get their large orders filled. So at the end of the day, like let's start here with us and understanding our part with this. We are retail, and retail collectively, like if we all was on the same chat server saying, yo, everybody pump the price, like yeah, we could do something, right? But we're not. Retail across the world, across the United States, across your state, etc., we're not all on the same page. We're all making different moves. But big money, where they drop $1 million orders, $2 million orders, $500,000 orders, those people, they are the ones that are moving our market. And the sooner that we realize that, then we can like kind of restructure the way that we think in regards to our trades. Because a lot of times when we get into our trades, we're thinking about our trade and our setup. And like, no, this is what I wanted to do. But you actually need to take that hour out and then think of what is big money trying to do. Because I'm actually riding their wave with my little $200 contract. Okay, like our $200, $300, $1,000 contracts are doing nothing in comparison to when big money and smart money steps in with a $1 million order. And that has happened to all of us in here, including myself. We'll be in our position. We're like, oh, I think the trade should go this way at this time because of this, that. We weren't even thinking about liquidity at all, right? So we get into the trade. Next thing we know, it reverses on us, knocks us out, either knocks your stop loss or knocks you out completely. After it does that, it goes to where big money wants it to go, only for it to get there, skirt, skirt, and then take back off in the direction that you knew it was supposed to go in. And all of you guys have seen this. That's something that you'll actually repetitively see until you understand that you and liquidity and big money are best friends. And that's literally like the key to a lot of this. You need to know where liquidity is. Like when I do the Trader Bay method class, it's five of the strategies that are literally based around liquidity, like all about liquidity, not about anything else. Because people have strategies here. If you stand on your head and if you do this, if you do that, then you know when to get in a trade. No, no, no. Those five strategies are only based on liquidity and knowing where it's at. And I'm like, yeah, that's when I focus and when I remember that and stop being a scatterbrain, those are my green days. Like for real, and those will be y'all's green days, all right? So just put that in your mind. We don't hold a candle to what market movers want. And when big players get in and want their large order fills, we are riding their wave to get their order filled. And that should be the only time that you execute an order, okay? All right. Liquidity tends to build up in very predictable places where traders place their stop losses and pending orders. Typical liquidity areas include previous high and lows, consolidation zones, order blocks and imbalances, and key cycle level round numbers. So, previous high and lows, you guys who've been with me in the Discord for a while know that I trade the strat and I do previous highs and lows like every single day. I'm like, what's the previous day high and low? Previous day high and low. And I always mark that off. Why? Because liquidity is sitting there. That's the highest that it got. So the previous day high is the highest place where we got. And then all of a sudden, either people took profit or sell orders started to activate. Okay. So there are people out there in the world, we might not do it as newbie traders, right? That literally use limit orders and they place their limit orders in strategic places, okay, for them to fill when we get to that level. Hence the reason why we'll be climbing up and then all of a sudden we get to a certain area and we can't get there because right along with people taking profit, limit orders for sellers are now filling and pushing the price back down. Whether that's a big money order or that's a retail order, it's filling. Okay. So liquidity sits there. Then we also have liquidity down at the bottom. So that's where buyers have their orders ready. Okay. They've strategically placed their limit orders. This is where they're looking to enter. And then liquidity is there. So liquidity, I'm going to give it to you in two examples that are very digestible for you to remember. Liquidity is two things. Liquidity is the gas that you put in your price action car to get to and fro on the charts. Without it, we're not moving anywhere. Without people losing money in the market, when we lose money in the market, we helped the market move to where it wanted to go because that's exactly what big money want to help fill what they got to fill and then to do what they got to do. Okay. So the price action car can't drive too far without driving towards that liquidity, grabbing that money, putting gas in the car, and then skirting and going to where it needs to go. Right. So that's one analogy that I have there. And it's so funny because spending all my time on that analogy, now I forgot my second one that I was going to use that was really good. That's why I should take notes on what I'm talking about. But we'll just leave it there. There you go. Price action needs liquidity in order to move the market. All right. So it's in consolidation zones. Remember when we're consolidating and we go, let's say I'm using SPY as an example. We go from 601 up to 605, back down to 600, then back up to 602, then back to 601, then back up to 62 and 50 cent. And we're ping ponging between these two areas. Those consolidation zones are building liquidity because there are people who are not in this class and there are people who are not taking classes, not in a Discord, didn't pick up a book, don't got a lick of knowledge about trading that are hopping in and out and getting chopped up. And y'all know I like to play the song Chopped and Screwed when that happens, right? By T-Pain and Ludacris. I'll put our little theme song on and be like, you've officially been chopped and screwed. That's literally those people. So as they're getting chopped and screwed, they're thinking that we're about to break out and we don't, and we drop back into the level. Then those think that we're about to break down and we don't, and then we pop back up and we keep doing that number. That consolidation zone is just building up all them people who got knocked up and knocked down and knocked out and knocked in and etc. Okay. All right. Then we're going to talk about order blocks. And order blocks is like literally where there's some orders that are needing to be filled, where heavy orders keep getting filled and like completely keep blocking us from moving forward. And then imbalances, so fair value gaps. Fair value gaps create liquidity, and I'm gonna tell you why if you don't learn nothing else from me. And that's another thing that I'm gonna teach about in Trader Bay method class. Okay. Freaking fair value gaps is because a lot of people go, I don't get what fair value gap even mean. What are you talking about? A fair value gap is where price moved so quickly it left orders open. Okay. It moved too quick and limit orders could not get filled. So those limit orders are still there because people who've been trading for a while that even know how to execute limit orders, they're not worried about it. They just chill. They know that eventually, even if we continue to rally up, one day their limit order is going to get filled and then they go on from there. So they're not pressed about it. They just chill. And so those orders are still sitting there. So for example, I would love to use gold. Gold was due for dropping like she's dropping. And I just didn't know what day it was going to happen on. So I did my normal routine where I should probably be up about $300. Instead, I left the market down was it 67 or 76? I'll say the highest one, $76 on my swing, okay? And the reason being gold had been gapping up every day and every weekend. Like when we left from Friday coming into Monday, she'd been gapping up for like months, guys. I kid you not. If you go to the ticker GLD for options and you look at the daily and the weekly, she created fair value gaps all those times. So there's all those people's out there sitting there waiting for their orders to be filled and they haven't filled yet. So it was only a matter of time that big money was going to get this rally going. And it's funny how they did it too. It was so freaking strategic that I'm going to put y'all on the game and myself. Nobody was paying attention to gold. Then all of a sudden, news like CNBC, my mom even text me or like call me downstairs like, Dan, you trade gold and they're talking about it on the news. I kid you not. Days after them talking about it on the news, all of a sudden we just flushed. And you want to know why? And thank God I only gave back $76 out of my hundreds that I got from them. You want to know why? Because big money wants to go down and push you know, pull the rug. All those people who were in that was sitting comfortably and like, oh, they're now stopped out. There's other people who are smart money, like we're going to be in our Discord. They're still in. They still got they swing. They swing red as they don't know what. But they say, you know what? My swing don't expire to November. I know what they're doing. Hear me out, y'all. They made all this ruckus about gold. Some retailers and some people got in. Let me invest more. Let me get some more. Let me get some more. They made us plummet on Friday. Everything was going up except gold, and that's weird. They're going back through, they're collecting all those orders from those fair value gaps. They're collecting them. They're activating fair value gap orders. They're going back and grabbing all that liquidity. They're going to get to a particular point, and this is another thing how it happens, right? They're selling us off, and we might even sell off on Monday, okay? Then people who like to short the market are going to go, yo, this easy money. I could short gold and be up like $1,000 in like 5 candles. Yo, I'm shorting gold. I'm getting puts on gold on Tuesday because they think it's going to keep going. I guarantee you they're going to hit that skirt skirt at one of them fair value gaps, baby. And they are going to rock it up. Mark my words. Mark them. Okay. Now, mind you, I was kind of pressed like a panini about my red day and this liquidity thing that we're talking about. And it's the best example I could give you because I lived it just now on Friday. But it was nothing in comparison to what people are about to go through. So there are people that lost thousands of dollars on gold and they were liquidity because they didn't understand how to swing and not do zero DTE. There are people who's going to lose thousands of dollars on gold. Why? Because now they're thinking, oh, this is an excellent place to short the market. Let me hop over here and short. Let me hop into puts. Let me hop into puts. And it's going to get to a point because they don't know about fair value gaps like y'all do. They don't know about consolidation zones. They don't know about previous highs and lows. They don't know about this stuff. It's going to get to that point. It's going to hit it, skirt, skirt, shoot back up, going to knock the shorters out. It's going to knock the bears out. And now it's gotten even more liquidity to put in this price action card to drive the price back up to where they really want it. Now, I would not be surprised if gold does not go up to like 5,000, 6,000. And again, mark those words. All right, next, key psych levels, round numbers. So liquidity likes to build up around key psych levels. Okay, this is why this is so important. People talk about this so much, and in my trading journey and learning and taking mentorships and classes, everyone drives key psych levels. And I think y'all forget about it every single day. The human psych likes round numbers. Even when this is why when you're in a store and they're like, would you like to round up to donate to such and such? People like that roundup. They don't like to see that they went to the store and spent $3.43 on something. So they rather round it up to the nearest dollar or the nearest 50, $3.50 or $4. They like round numbers. It's easier to compute. Guess what? So does the market. So when you go to your ticker, you guys don't even realize this. They literally equip you with how your ticker moves for key psych levels. Because if you look at SPX, if I'm not mistaken, they give you every $10. She'll be like 66.10, 66.20, 66.30. That's telling you that she likes the tens. But then if you go over to Q's, they give you 5.50 and 50 cent, 551 and then 551 and 50 cent. They give you 50 cent increments, and they literally, it's a mind game that the chart is even showing us that, because literally that's what you're thinking, and that's what people are thinking with key psychs and setting their orders. As soon as we get to that nearest 10, I'm finna hop in. As soon as we get to that nearest 50 cent, I'm finna hop in. And guess what? Big money, smart money already knows that. That's why people are liquidity. All right, next. Price doesn't move randomly. It hunts liquidity. When price breaks above a previous high, it triggers stop losses. It's providing liquidity for big players to enter in the opposite direction. That's what we call a liquidity grab or a stop hunt. All right. So when people are like, hey, grab liquidity in your mind right now for me, imagine this. You're watching SPX, you're watching ES, you're watching SPY. We're climbing up. Price shoots up with a nice candle, boy. And you're like, yeah, I'm finna enter. All of a sudden, it rejects right back down. It leaves a long wick, and then it goes to the downside. And then someone goes, that was a liquidity grab. Exactly. They wanted to grab the money from up in that area, the orders, they wanted to stop out sellers or whatever the case is. And when they did what they needed to do right at that swing high, bloop, it drops. So there are people who are really brilliant at trading that wait for those moments to get into the market. Those people need to be you too, okay? That needs to be you as well. You should be looking for these pivots, these reversals, these liquidity grabs, and then now you moving real smart. Now you're smart money, you owe money, all right? So think of institutions as needing liquidity to execute large trades. They push the price towards areas with a lot of stop losses to trigger those orders, then reverse the market. This creates the illusion of a breakout, but it's really an engineered liquidity collection. So let's talk about this real quick. When I'm in the market, I don't play breakouts. I do not play breakouts. Y'all will see me drop down to the 1 minute. Somebody like, yeah, I need to be on a one. Yes, yes, the heck I do. Yes, I do. Because if you're on a 5 minute at a breakout point, it'll just look like in those 5 minutes, you'll see your candle above that spot, and you'll be like, okay, everything's good. Baby, everything's not good. No, everything actually is not good. Because if you drop it down to the 1 minute, you would see that we're on a big bodied candle that's about to shoot up past that point. It's going to wick and drop back past that point, and now you're going to be stopped out. That's what you're about to see. Okay. So on the 1 minute, it shows you a shooting up, coming down, retouching your level. The candle will come right back to your level, tap that previous day high, and then it will go up. And that lets you know that that is not a liquidity grab. That will let you know that it's not a false breakout. So that's why I like the 1 minute. And I will tell you guys about how you can set up your chart to be able to pay attention to all the minutes that you like. Your higher time frame, like that middle time frame of about an hour, the 4 hour, the 5 hour, the 6 hour, whatever, and then your lower time frame, because you need to see price come back to that point, and you can't see it on five. I've tried it. It doesn't work. So we will talk more about that 1 minute, okay? You don't live on the 1 minute after you enter. You utilize the 1 minute to be a trade ninja and execute, okay? All right. A liquidity zone is a price area where we expect clusters of orders. We mark these zones to identify where price is likely to react, either to reverse or to continue after taking liquidity. So it's funny. At the liquidity zone, sometimes it doesn't always, skirt skirt and go back in the opposite direction. It'll like chop people up in there and then get right here and then whoop, just like that. So literally price will do up. And I don't know if y'all can even see my pointer, but it's like going up, it'll come down and it'll do the little consolidation, bounce between the range, chop people up, chop and screw them, and then it'll shoot up. That's what they're saying to continue after taking liquidity. Let's go through the steps of liquidity zones on a chart. So you want to start from a higher time frame and mark your major swing high and low. That is the equivalent of marking previous day highs and lows. So everyone in here, I don't care if you trade the strat or not, everyone who's going to watch this later, you need to be marking previous day high and low every single day that you come to the market. You need to mark it on your chart with you could do the ray. You could do the ray and you can do it large or you could do it short, but you need to do it. Let me make sure I'm not missing any chats here. I'm so sorry, y'all. Okay, no, I'm not missing any chats. Perfect. Okay. Then you need to identify consolidation areas or untested zones. So it's okay. Consolidation areas definitely could be an area that we could pivot at, or where more orders will sit. So what you do is you go down to a time frame like the 15 minute, the 10 minute, like 15 to 5, anywhere up in there, and see where price just kind of was stagnant for a second. And it may have sat there for like an hour. Sorry, y'all, I got two little ones. It may have sat there for like an hour. It may have sat there for like 30 minutes and then it shot up or it shot down. Pay attention to those zones as well. You would put a box on those zones and then have it extend right so that you know that when we get to that area in the future, we could do the same thing. Okay. And then you refine those zones on lower time frame for entry. So remember how I said we would execute on the 1 minute. Correct. Correct. All right. So now that we know where liquidity is, here's the basic trading approach. You wait for price to tap or sweep the liquidity zone. You're going to look for confirmation, a break of structure, or a reversal candle. You're going to enter in the opposite direction of the sweep, and your stop loss is beyond the zone. Target the next liquidity area. So that was very formal. I'm going to say it in my own words. We're waiting for that crazy big candle with the big wick. When we see that, we're going to go ahead. That is, we're now in a discount zone for a put. Let's pretend like it's a swing high. Once we see that huge wick, you're going to be like, okay, bet I got my eye on this put down here. You're going to get in that put. It might be freaking $30 or something, right? You get into that put at $30. Then when you see that sweep and it is confirmed that we have the break of structure or a reversal candle. Give me 1 second, my little one. Hold on. All right, guys, I'm back. My little one, she wanted to talk, but I was like, hold on, girl. All right, so now price literally shot up. We see this sweep. We see this large wick, and now price is coming back down. But this is how you got to plan your day. You should already have in your mind which put you would buy if we were to drop and which call you would buy if we were to rally. That should already be in your mind so that you're not fumbling on your options chain looking for, oh my God, oh my God, oh my God. Okay, so I think I just saw liquidity and shoot, on SPY, which one God darn it, is it like a I think I'm gonna get a 580, like how much this one costs. Don't do that. Before your day starts, know which put you would like and know which call you would like. And you know what would really be cool if they allowed us to save those. Like, like how we be saving posts on freaking TikTok and Twitter. If we could save an option, oh my God. And if that exists, y'all, forgive me that I don't know that it already exists. But anyways, you need to know which one you're going to enter, whether we are dropping or whether we're rallying. Okay. So then you're going to look for that confirmation or the reversal candle that is nice and strong and big. And then you're going to go ahead and click buy. And then boom, we're entering into the opposite direction of the sweep. Okay. And your stop loss is just beyond the zone. Okay. So you just want to make sure that you do have a stop loss. Now, we'll talk about stop losses on another one because I would rather have my stop loss not just below the zone. because I don't want to get like wicked out, so to speak. I struggle with with that. I don't want to be liquidity, so sometimes I don't use stop losses, or I might start using OCOs to lock in the profit. Okay, OCOs, and we'll talk about OCOs in another class, or you could look it up on your own between now and then. Okay, all right. So here we go. Here's a clean example. Price takes out the previous low. That's a liquidity grab. Then reverses with a strong bullish candle. You enter after the confirmation. Your stop loss is right below the sweep. The target is the next high or zone. Okay. Here are a few mistakes that traders often make. You enter before liquidity is taken too early. You don't wait for confirmation. You're marking too many zones. You're ignoring higher time frames context. So remember, fewer cleaner zones give better clarity. And I definitely agree with that. And that's what I'm building Trader Bay method off of. So let's recap what we've learned. Liquidity equals where order sits. Price hunts liquidity to fill institutional orders. Liquidity zones help us anticipate the movement and not chase it. And then patience and confirmation are key. So we got practice here. Now, practice is going to be for us to do over in the Discord if you're interested. So if you guys are interested, you don't have to do it right now, but I would like for you to look back at either SPX, SPY, and ES, and I want you to mark 3 swing highs and swing lows, and then identify where liquidity was taken and where price reversed, okay? And then you're going to post the findings over in our Discord, okay? So I will create a tab that says homework. I'll do it right now because I am very good at forgetting stuff, and I need y'all to do that homework with me, okay? So this is today's homework. All right, so let me see here. I'm gonna create this tab right now under learning resources, okay? So learning resources, let's go ahead and hit create a channel, and then let's create homework. Oh, wow, my Discord just closed out before I could even do it. Let's try one more time. Okay. Learning resources. Let me see. We're gonna hit, where is it? My girls are just talking up a storm today. Are you gonna let me type in homework? Is it okay? It's let me do it, guys. Homework. Boom. Create. I did it. Okay, so under learning resources, we have a tab called homework. Again, I'm gonna take a screenshot of this right here, and I'm gonna put it in there, but mark 3 recent highs and lows. And then we're gonna identify where liquidity was taken and where price reversed. We're only gonna do it on SPX, SPY, or ES. And then we're gonna post it in homework, okay? So there's that. Remember, smart traders don't chase price. They wait at liquidity zones where the big players move the market. The market moves from liquidity to liquidity. Learn to follow the flow. All right. So that is literally everything. All right. So now I'm going to check in with you guys and see, do you have any questions for me? Did everything make sense? Do you feel a little bit more like, okay, I think I got it a little bit in regards to liquidity? I have someone here that I want to speak, but I gotta see if she's available. I would love for Jess, Spice Girl, to say a little something for me in regards to like how she deals with liquidity, or anything that she wants to say to you guys. Because remember, they're doing Brandon and Jess are doing their mentorship. And I'm pretty sure they're going to discuss this in their mentorship at greater length. So I just wanted her to swing through. Jess, are you available to say something, love? Let me see. Maybe not. We'll see, because she's stopped in while she's out and about. So let me see. And then while I'm waiting to see if she's able to say something real quick, my loves, do you guys have any questions? Does anyone have any questions for me? I don't see nothing in the chat. So I'm guessing we're good. I'm guessing. And then let me text Jess and see. There she is.
Sorry, I had got a phone call.
It's okay.
I literally was like, why would somebody call me right when I just had a feeling I was about to talk. Um anyways, you did amazing.
Thank
I
you.
just want to say that. Hi everyone. I don't know if you guys were on the call yesterday, but if not, I'm Jessica. I don't know what you just said. Am I supposed to introduce myself?
Yeah, you can. You can.
Okay.
We got like 5 minutes left and you're gonna have those five. So you can say who you are and what you feel about liquidity in
Okay.
general. Yeah.
Yeah. Yeah. So, my name is Jessica, the Jess of all trades, aka Spice Girl. I'm I'm really like the GOAT at Spy. Um,
Mm-hmm.
and yeah, if anyone else says they are, they're lying. It's me.
For
Check the
real.
win rate, okay, baby. Check the percentages. They're in
Okay.
my server. Like the proof is in the pudding.
It
Um,
is.
but yeah, no, so she did amazing, you guys. What she's telling you is absolutely 100% accurate. If you guys haven't watched the movie Dumb Money, I believe it was on Netflix. I don't know if it still is, but it's called Dumb Money, and it's really entertaining. But it's kind of like loosely based on the GameStop situation, and the guy who created that whole meme coin and everything. And it kind of goes over kind of like what she's talking about. You kind of see the behind the scenes of these investors coming up with these plans and plots to fix the markets and grab that liquidity and all that kind of stuff. But it's like a super, yes, Dumb Money. It's a great movie. So if y'all have not seen it, watch it. Um, it's like I said, it's a good way to kind of get a little entertainment. So because trading can be a little strategic and very right-brained, like logical and stuff all the time. So it's kind of a fun way to kind of get an idea of how things work with these institutions and what they're doing behind the scenes, and how this guy, I think his name was like Hello Kitty. It was something really weird.